Sarah buys gold, Marcus buys Bitcoin. They both invest $10,000, they both think they're making the smart play. One of them is right about something critical, the other is wrong about something expensive. When you run the actual numbers over 10 years, the gap between getting this decision right and getting it wrong will shock you. Not because one asset is better, but because most people never understand what they're actually betting on. Let's keep this fair. Sarah and Marcus are both 32 years old. Both just received a $10,000 bonus from work. Both want to invest it for the long term. Same starting capital, same timeline, same goal. Grow wealth over the next decade. The only difference? Where they put that money. Sarah is a traditionalist. She doesn't trust things she can't hold. Gold has been a store of value for 5,000 years. Governments collapse, currencies fail. But gold always has value. She buys $10,000 worth of physical gold at $1,800 per ounce and stores it in a secure vault. Sarah owns 5.56 ounces of gold. Tangible, proven, safe. Sarah feels secure. Her wealth is protected. Marcus is a digital native. He sees the future in blockchain technology. Bitcoin is decentralized, scarce, and growing in adoption. Institutions are buying. Countries are watching. He buys $10,000 worth of Bitcoin at $30,000 per coin and stores it in a cold wallet. Marcus owns 0.333 BTC, digital, volatile, potentially explosive. But Marcus knows something Sarah doesn't. He knows what Bitcoin does over long cycles. On day one, Sarah looks like she made the smarter choice. Physical gold. No volatility, no risk of going to zero. Marcus bought an asset that could crash 80% overnight. But day one is not the scoreboard that matters. Here's what Sarah doesn't realize. Every dollar sitting in gold has a silent enemy. That enemy doesn't announce itself. It doesn't show up in her vault statement. It just waits. Its name is opportunity cost. Gold doesn't pay dividends. It doesn't generate cash flow. It doesn't compound. It just sits there, waiting for fear to drive the price up. Every year Sarah holds it, she's betting that someone else will be more afraid than she was when she bought it. Meanwhile, Marcus's Bitcoin is locked in a vault with a different kind of timer. Every 4 years, Bitcoin's supply gets cut in half. It's called the halving. Every halving in history has triggered a massive price increase 12 to 18 months later. Sarah's gold has no such mechanism, no programmed scarcity, no predictable cycles. This is the fundamental difference between a static store of value and a dynamic digital asset. Year 1. Sarah's gold climbs to $1,950 per ounce. Her $10,000 becomes $10,833. Up 8.3%. Steady. Predictable. Marcus's Bitcoin crashes to $16,000. His $10,000 becomes $5,333. Down 47%. Sarah checks in. You okay? Marcus shrugs. It's done this before. I'm holding. Year 2. Sarah's gold hits $2,050. Her portfolio, $11,395. Up 14% in 2 years. Safe. Boring. Marcus's Bitcoin recovers to $45,000. His portfolio, $15,000. Up 50% from entry. Up 180% from the bottom. At this checkpoint, Marcus is ahead by $3,605. But the real gap hasn't opened yet. Year 3. The Bitcoin halving happens. The supply of new Bitcoin gets cut in half. Demand stays strong. Supply drops. Basic economics takes over. Bitcoin explodes to $70,000. Marcus's portfolio, $23,333, up 133%. Sarah's gold, $12,222, up 22%. Year 4. Bitcoin hits a new all-time high, $105,000. Marcus's portfolio, $35,000, up 250%. Then the crash comes. Bitcoin drops 65% over 6 months, falls to $36,750. Marcus's $35,000 portfolio drops to $12,250. People mock him. Told you it was a bubble. Marcus doesn't flinch. This is the cycle. He's prepared for this. Sarah's gold, $12,222, up 22% over 5 years. Marcus's Bitcoin, $16,666, up 67% from entry, but down 52% from the peak. Marcus is only ahead by $4,444. Sarah checks her gold once a month. It barely moves. She's fine with that. Marcus has watched his portfolio swing from $10,000 to $5,000, $333 to $35,000 to $12,250 to $16,666. Was the volatility worth an extra $4,444? Year 7. Another halving. History repeats. Bitcoin climbs to $95,000. Marcus's portfolio, $31,666. Year 9. Bitcoin reaches $150,000 as nation-states begin strategic reserves. Marcus's portfolio, $50,000. Year 10. Gold reaches $2,400 per ounce. Sarah's $10,000 investment is now worth $13,333. Gain, $3,333. Total return, 33%. Bitcoin hits $190,000. Marcus's $10,000 investment is now worth $63,333. Gain, $53,333. Total return, 533%. The gap, $50,000. Same starting capital, same timeline, one asset returned 16 times more than the other. But here's what the numbers don't show. Sarah's gold journey was smooth, boring, predictable. She checked her portfolio once a month. It barely moved. No stress, no panic, no sleepless nights. Marcus's journey was psychological torture. Year 1, down 47%. Friends told him he was an idiot. Year 2, up 50%. Felt like a genius. Year 4, up 250%. Felt invincible. Year 4.5, down 65%. Questioned everything. Year 10, up 533%, vindicated. Marcus experienced 4 separate 50% plus crashes over 10 years. Each time the headlines screamed, "Bitcoin is dead." Each time his family asked, "When are you selling?" Each time he had to fight the urge to panic. Here's the plot twist. Most people who bought Bitcoin with Marcus in year 1 didn't make it to year 10. 50% sold during the first crash, 30% sold during the second, 15% sold during the third. Only 5% held the entire 10 years. Marcus made 533% returns not because Bitcoin went up, but because he had the psychological discipline to hold through 4 separate 50% plus drawdowns. Sarah's 33% return didn't require discipline, it required patience. But wait. There's another layer. Marcus's 533% return assumes he bought at the right time, right before a halving cycle. If Marcus had bought at the peak in year 4 $105,000, he'd still be down 45% by year 10. Timing matters for Bitcoin. It barely matters for gold. Sarah could have bought gold at any point in the decade and gotten similar results. Marcus needed to understand Bitcoin's 4-year cycles to know when to hold and when to expect crashes. Knowledge reduced his panic. Ignorance would have destroyed his returns. Gold isn't sexy. But here's when it's the right move. 1. You're close to retirement. If you're 60 and retiring at 65, you don't have 10 years to ride out Bitcoin's volatility. You need stability. Gold gives you that. 2. You're protecting a large amount of wealth. If you have $500,000 saved, putting even 10% into Bitcoin means you could lose $25,000 in a single crash. Gold won't give you life-changing gains, but it won't give you life-ruining losses either. 3. You can't handle volatility. Be honest with yourself. If a 50% drop would make you sell in a panic, Bitcoin will destroy you. Sarah's 33% return is better than Marcus's negative 47% loss if he sold during year 1. 4. You're protecting against currency collapse. If your goal is to preserve purchasing power during hyperinflation or government instability, gold has 5,000 years of proof. Bitcoin has 15 years. Gold is the safer bet for true wealth preservation. Bitcoin's 533% return isn't luck, but it only works under specific conditions. 1. You have a 10-plus year timeline. If you're 25 to 40 years old and investing for retirement, Bitcoin's volatility becomes irrelevant. You have time to ride out the crashes. 2. You can afford to lose the money. Never invest money in Bitcoin that you'll need in the next 5 years. Marcus could afford to watch his $10,000 drop to $5,000 because it wasn't his emergency fund. 3. You have the discipline to hold. This is the hardest part. You have to watch your portfolio drop 50%, 60%, 70%, and not sell. You have to ignore your friends, your family, and the news telling you it's over. 4. You understand the cycles. Bitcoin isn't random, it follows patterns. Marcus studied the halving cycles. He knew when to expect crashes and when to expect rallies. Knowledge reduced his panic. 5. You want asymmetric upside. Gold will never 10x. It might 2x in an extreme crisis, but that's the ceiling. Bitcoin can 10x, 20x, even 50x, but it can also drop 80%. If you're young and want life-changing wealth, Bitcoin's risk-reward makes sense. Sarah's path is emotionally right. Gold feels safe, tangible, proven. It's been a store of value for 5,000 years. For most people, that peace of mind is worth giving up the 500% upside. Marcus's path is mathematically right if you have the right conditions. Long timeline, risk tolerance, psychological discipline, money you can afford to lose. But here's what you can't do. You can't buy Bitcoin, panic during the first crash, sell at the bottom, then buy gold and tell yourself you tried crypto. That's the worst of both worlds. You also can't put your entire life savings into Bitcoin and hope for the best. That's not investing, that's gambling. The smartest investors do both. 8, 0, 90% in traditional assets, stocks, bonds, real estate, gold. 5 to 10% in high-risk, high-reward assets, Bitcoin, crypto, startups. That way, if Bitcoin goes to 0, you're fine. And if Bitcoin goes to $1 million, you're rich. Sarah and Marcus both walked away from that $10,000 decision thinking they were right. Sarah thought safety was smart. Marcus thought risk was smart. 10 years later, one made 533%, the other made 33%. But neither was wrong. Because the real question isn't which asset performs better. The real question is which asset matches your psychology. Can you watch your investment drop 70% and not sell? If yes, Bitcoin might make you rich. If no, Bitcoin will make you poor. Gold won't make you rich, but it won't make you poor either. So here's the only question that matters. What scares you more? Missing out on life-changing gains? Or losing everything? Because the asset that wins is the one you can actually hold. And that's different for everyone.
Now that you know the differences, the next step is yours. Whether you're drawn to gold's stability or Bitcoin's upside, the worst move is doing nothing. Drop a comment below, are you Team Gold, Team Bitcoin, or hedging your bets with both? And if this helped you think clearer about your money, subscribe, because we break down decisions like this every week. Disclaimer, this video is for educational and entertainment purposes only. Nothing in this video constitutes financial, investment, legal, or tax advice. The scenarios, projections, and figures presented are illustrative examples based on historical data and hypothetical assumptions. They are not guarantees of future performance. Past performance of any asset, including gold and cryptocurrency, does not guarantee future results. All investments carry risk, including the possible loss of principal. Cryptocurrency investments are highly volatile and speculative. Always do your own research and consult a qualified financial advisor before making any investment decisions.